Thanks for tuning in to Talking Point. I'm your host, Niraj Shah, and our guest today is Nimesh Chandan, CIO of Bajaj Finserv Asset Management. The case for a chat today with him, the most obvious question that comes to mind for almost everybody, that what will drive the markets higher, valuations or momentum? We'll talk about the mega trends for long-term wealth creation and, of course, dwell on a topic that has been topmost for everybody, PSUs. And it's great to talk to somebody like Nimesh about PSUs because I don't have a barometer of how he thinks about it, so it's a thought afresh from our perspective in understanding from him. Nimesh, great having you. Thanks for taking the time out. Lovely having you on Talking Point.
Good morning, Niraj. Pleasure to be here.
Yeah, the pleasure is entirely ours, I must say that. So Nimesh, at the outset, the first question is about whether you're constructive on risk assets, including Indian equities, for 2024 and maybe slightly longer, after what's arguably been a banner year, at least for the broader end of the spectrum.
So let me divide it into two parts. We track markets based on fundamentals, what we see, and we also follow certain behavioral indicators, which kind of tell us where the pendulum is leaning or moving toward, whether it is bullish sentiment or bearish sentiment. On a fundamental level, we believe we are very close to fair value levels as far as the Nifty levels are concerned. The small cap universe would be trading slightly above average of what they have historically traded. They are not into a bubble zone yet, but they are above average valuations. Nifty is close to fair value, and here then you have to be very, very specific on what you are selecting as stocks to invest in to actually create better returns. 2024, while every year is in a way a stock picker's year, but it becomes more so in 2024 because we are stepping into 2024 with reasonable to slightly higher valuations for many sectors. Now, on the other side, on the behavioral side, the pendulum is still bullish. So the indicators we track from different markets on different periods of time, we see the momentum to sustain, the bullish sentiment to sustain. It is probably fueled more by seeing the interest rates peaking and more flows expected to come into India. But those indicators, almost all of them, are still on the bullish side.
Okay, and I was okay. You know, let's talk about the behavioral pattern in slight detail because market-wide that has an impact. You know, viewers, a lovely book to read is The Crowd by Gustave Le Bon, way ahead of its time when the book came out, and gives us a great insight into how crowds think. But for all of you who can't read, let's ask Nimesh, how would the behavior of the public at large or the crowd at large impact what's happening to the already skewed mid-cap, small-cap end, even the primary market end, if you will, because clearly what's happening out there is indicative of some bit of froth. If not at the mid-caps and the small-caps, then certainly what's happening in the primary markets, Nimesh.
Right. So as you know, Niraj, that even when markets go into overvaluation territory, they don't fall immediately. The opposite is also true. When they are completely undervalued also, they don't start moving up immediately. There are always triggers, and that impact the sentiment of the crowd and then leads to buying or selling based on the information that has come. So we track various markets and see how each market expresses its bullishness and bearishness. And we track global markets and different markets like commodities, currencies, bond markets, as well as equity markets. Now let's take an example. How do, say, metal markets tell you that they are bullish? So typically, when metal markets are bullish on economies and business cycles, they would buy industrial metals and they would sell precious metals like gold. So that ratio changing gives you an indication of what the metals market is thinking. Say the bond market. Bond markets typically, you see the spreads going down between corporate bonds and government bonds when they are bullish on the economy, when they expect the corporate sector to do well. And obviously the opposite when they are bearish. Look at equities. Equities are typically a little late to react, but the momentum on, say, small caps versus large caps, defensive sectors versus cyclical or, say, high beta sectors, these are the indicators that tell you what the crowd is thinking and whether they are looking to turn. So, for example, last few days we are seeing a good rally in pharmaceuticals. Now, that can be an alert that are people looking to more defensive positioning because the valuations have reached a certain level. We look at we don't expect all the indicators to give us a bullish or a bearish trend, but we look at what the majority are pointing to. And as I said, they are still pointing towards more bullishness, and I think that will push the momentum and will continue to move higher.
That's an interesting point you raised, because when we were looking at, I was looking at the list of equity funds that have done the best in 2023, and I know 1 year is not a good time frame to look at fund performances, but humor me, if you will. Value funds came to the fore in a big way in 2023. Now, just using that as a barometer, that fund managers have moved towards buying some bit of value, right? I'm trying to understand if that pattern, Nimesh, continues well into 2024 when the markets are looking expensive. Would you, as a fund house, also largely stick to that kind of philosophy across your fund offerings?
It's an excellent point, Niraj. So what we see is typically cycles of 3 to 5 years between even styles that outperform for a certain period of time. This may not be an exact match in terms of exactly 3.5 or 4 years and things change or so, but it does give you an indication that what is the high probability from here on. Now, you are absolutely right. From 2020 onwards, there was a hunt for value. And we have seen now, at least in 2023, being expressed more strongly. But we've seen more like a 3-year rally in terms of value stocks and value companies. So I think a lot of that juice is already priced in. On the other side, what we see is the quality stocks, or I would say so-called companies which have steady growth, good return on capital, good cash flows, and were considered to be, say, in 2018, the safest bets to be in. Those for 5 years have kind of underperformed, 3 to 5 years they've underperformed. And going into 2024, then I think that becomes a better positioning than value. Not that the momentum in value will immediately go down, but the positioning for an investor who's looking for where is the next wave coming, I think the positioning should be on the quality side.
Okay, but that's interesting, because I think the underperformance, I mean, they went through this bout, and I'm glad you mentioned cycles, because I think they went through this bout of severe outperformance, wherein it was quality at any price until maybe COVID hit, or maybe for 6 months, 12 months after that. You think the hibernation ends because of globally linked factors as well? Because a lot of talk around how if rates come off, then what happens to growth stocks and quality stocks versus what comes to value? Is that a factor as well?
So what we look for is which is a style or which is a sector or companies which are underappreciated or underpriced. Now, this is slightly different from value. So let's think of it this way: when market is focused on one side of, say, a theme with the sector or certain set of stocks, those become overpriced, and what market is ignoring on the other side become quite attractively placed or underpriced. Sometimes value as a style becomes underpriced, so nobody's looking at value. Say if you brought a value fund in 2018 or 19, people would really wonder why you're bringing such a fund. Now think about it this way, that the quality stocks are underpriced compared to what the premium they used to have over other growth styles or value styles in the past. And that becomes underpriced or underappreciated. If I'm paying, say, a 40 or a 50 price to earning ratio for all the companies, I better pick up something where I know there is a moat, the business has a certain scalability and the return ratios are good, because that deserves a higher valuation compared to just a cyclical, say, a sector or a company that gets the same valuation.
Got it. Nimesh, but can't that last for a lot longer than what sanity might suggest as a change of style, right? We've seen FMCG counters back in 2010, right? 2000 to 2010 go through that period of severe flatline performance despite the fact that they were high quality stocks and didn't do anything for such a long time. I mean, sorry to use this name as an example, but Avenue Supermart's high quality stock the last 2 years has done nothing, right? So can't that last for a bit longer? How are you so confident about taking this pivot, if you will?
So we look at areas which are underpriced, and we also look at some triggers that can really come in. Now, many of these companies, if you see, which have underperformed for the last 3 to 5 years, are typically in the consumer sector, in consumer discretionary, say. We've also seen many of them, say, in the private banking side, where valuations are at a 5-year or a 3-year kind of a low, or sometimes even a decade low in some cases. Now we look at the trigger, whether there are any business triggers for them. We see on the consumption areas triggers coming in. Typically, when the economy does well, per capita income is growing, discretionary spends starts coming in. Also, when the capex cycle of a country starts, it has a follow-through effect into consumption. So because of higher employment, higher salaries, recruitment, you see then a follow-up coming in terms of consumption side also. You've seen certain areas where there was a kind of a revenge spending or a post-COVID kind of surge in travel, in hotels, QSRs, and so on. I think a lot of areas where, say, bottom of the pyramid was not doing very well, say on the rural consumption side. Now, these areas are showing some green shoots or positive vibes, and I think that those can be the theme for the coming year. No, you are absolutely right. Markets can continue to be valuing only, say, certain defense sectors, PSU sectors, which they have done very well in 2023. But a smart investor would know that this is where the fair valuations have come in. And with the visibility of these cyclicals versus the structural plays, it is time to start considering the structural side of the business.
Okay, we'll talk more about this on the other side of this very quick break. Nimesh, stay on. Lots more to talk about. Be back in just a bit, viewers. Back with Talking Point in conversation with Nimesh Chandan, CIO, Bajaj Finserv Asset Management. Nimesh, I heard you speak about triggers. I hate you speak about undervalued stocks. I would love to understand about pharmaceuticals because I heard you mention that space as well, if I'm not wrong. Now, tell us, because that pocket has been in flavor now for the last few days. Is this the market turning towards an underperforming sector, likely having triggers and valuations in its favor, or are there other reasons?
So pharmaceuticals had many years of underperformance, and frankly, when some of the IPOs came in, I was worried that why are they pricing it so high? But then the market started turning favorable towards the domestic-oriented stories first. And domestic-oriented stories are better to play pharma side, and then there's a few listings, and then the whole sector starts getting re-rated upward. Then there's some positive news that came from, say, the generic side or the US generic side, where you saw pricing kind of action bottoming out. There was aggressive discounts of packs earlier. Now the generic pricing starts bottoming out. So that comes as a fresh trigger for re-rating in pharma. However, in my experience, whenever the pharma sector overall moves together, I think it shows something about investors rather than the investment, that people are looking for ideas where they have some, say, a defensive kind of a growth play. And I think this is what has moved pharma as a club. Otherwise, each company has very different kind of markets that they cater to, different geographies, different therapeutic segments, different molecules, different R&D pipelines. So overall, I think the move in pharma is because it has underperformed for quite some time. They got re-rated upward now. From here on, we'll have to be more selective. We are bullish, and we continue to be bullish on the domestic pharma space because we see that as a structural story. We continue to be bullish on the other healthcare space where, say, hospitals or diagnostics labs are concerned. So those offer, according to us, also good opportunities for a long-term investor. So pharma pack can possibly keep continuing on the upward journey, but we will see separation of men from the boys, where people are more confident about long-term prospects, those getting higher valuation rather than the entire pack.
The other question, and we wrap up this conversation with that, but is on information technology, Nimesh. Again, anybody's guess, a bit of an uptick in the prices and the valuations recently, but the commentary suggests that it's still caught in a quagmire of sorts. Are you constructive? Are you negative?
I'm a bit cautious on that, and especially after the move that we have seen, maybe expectations have moved up quite a bit. We've seen guidance cuts this year by some of the major IT services companies, and in the US, all the indications are there will be a soft landing, but a landing. It's not going to be a resurgence of growth or anything that is expected, and which is why Federal Reserve is looking to cut rates. Typically, these are good businesses, but when the clients are not doing so well because of their economic growth being slow, doesn't mean that there will be a surge in spending or a good pickup in IT services business. So overall, great companies in terms of cash flows and ROEs, but I believe expectations have moved up significantly in this side of the market. Maybe we see some downgrades coming if the economy globally slows down further.
Okay. Sorry, I'm squeezing in one more, because you had mentioned that you look at both ends of the crowd behavior or the popular, unpopular thing. What was popular, ranked popular in 2023 was PSUs. Right, Nimesh, I'm trying to understand. You can't brush, I mean, we can't brush the whole pack with the same brush, I know, but, or the same color, but everything moved up. Now, is there merit in select pockets in the PSU basket, or are you cautious because typically the basket moves as a pack?
No, definitely there is merit. Again, here we'll see separation of men from the boys, where we've seen certain companies having good order books, good execution capabilities, better margins and working capital, especially with them. Those can continue to do well. However, I think there is some bit of exuberance there. There is in the space overall that people are excited to hear about stories on PSUs and then start pricing them in very quickly. So maybe a correction is due, but it's not an end of, say, the bull market for PSUs. Some of them can continue to do well. Some of the stories that we are seeing in terms of defense, in terms of renewable energies, in terms of overall power capacity in the country, those are pockets which will continue. So it's about how much has already been priced in, how many years of order books and growth have priced in. So, and you are right, we can't paint them with the same brush.
Right.
So here we will see some kind of correction and then probably separation of men from the boys.
We'll try and talk about this in detail and the other conversations that we do, Nimesh. But lovely talking to you. Thanks for taking the time out and being with us today.
Pleasure being here. Thank you.
That's the wrap on Talking Point, viewers. Thanks so much for tuning in.